The Enron scandal stands as a stark reminder of the dangers of unchecked corporate greed. It is a story that has been etched into the annals of financial history, a tale of ambition, deception, and ultimate ruin. It is a tale of ambition gone awry, where the pursuit of profit trumped all ethical considerations. The relentless drive for financial success led to a culture where the ends justified the means, no matter the cost. In the annals of financial history, Enron's collapse ranks among the most notorious, serving as a cautionary tale for generations of business leaders and investors alike. The company's downfall was not just a financial disaster, but a moral one, highlighting the perils of corporate malfeasance. This is the story of how a seemingly invincible energy giant built a house of cards on a foundation of deceit, ultimately leading to its spectacular downfall. Enron's rise and fall is a dramatic saga of corporate hubris and the catastrophic consequences of unethical business practices. Enron's roots can be traced back to the 1980s, a period of deregulation and rapid growth in the energy industry. This era provided fertile ground for ambitious companies looking to capitalize on new opportunities. The company, formed from the merger of two natural gas pipeline companies, initially focused on the transportation and distribution of natural gas. This merger was seen as a strategic move to consolidate resources and expand market reach. However, under the leadership of its ambitious CEO, Kenneth Lay, Enron embarked on an aggressive expansion strategy, venturing into new and often complex markets. Lay's vision was to transform Enron into a diversified energy conglomerate. Lay's vision was to transform Enron from a traditional energy company into a global trading powerhouse. He believed that by leveraging innovative financial strategies, Enron could dominate the energy market and beyond. Enron's early success in trading natural gas contracts fueled its ambition. The company's traders were known for their sharp instincts and willingness to take risks, which initially paid off handsomely. The company's traders were known for their sharp instincts and willingness to take risks. They embraced a culture of innovation and bold decision-making which set Enron apart from its competitors. They embraced new and innovative financial instruments such as derivatives to hedge against price fluctuations and generate profits. These complex financial products allowed Enron to manage risk and maximize returns in ways that were previously unimaginable. Enron's trading floor became a hotbed of activity, with millions of dollars changing hands every day. The frenetic pace and high stakes created an environment where success was measured by the ability to outmaneuver the competition. The company's stock price soared, and Enron was hailed as a Wall Street darling. Investors were enamored with Enron's innovative approach and seemingly endless growth potential. However, beneath the veneer of success, a darker truth was beginning to emerge. The aggressive tactics that had driven Enron's rise were also sowing the seeds of its downfall. Enron's aggressive accounting practices, designed to inflate its earnings and hide its growing debt, were catching up with it. The company's financial statements were becoming increasingly convoluted and difficult to decipher. The company's complex and opaque financial statements masked a web of off-balance sheet entities and questionable transactions. These entities were created to keep debt off Enron's books, giving the illusion of financial health. These entities, designed to keep debt off Enron's books, would ultimately prove to be its undoing. As the truth began to surface, the company's carefully constructed facade started to crumble, leading to one of the most dramatic corporate collapses in history. The 1990s witnessed Enron's meteoric rise to prominence. It was a decade marked by rapid technological advancements and a booming economy, setting the perfect stage for Enron's ambitious growth. The company's aggressive expansion into new markets, coupled with its reputation for innovation, made it a Wall Street darling. Enron was not just another energy company, it was seen as a trailblazer, constantly pushing the envelope in the energy sector and beyond. Investors were drawn to Enron's consistently strong earnings growth and its promise of continued success in the burgeoning energy sector. The company's ability to deliver impressive financial results quarter after quarter created a sense of invincibility among its shareholders. Enron's stock price soared, reaching an all-time high of over $90 per share in August 2000. This remarkable achievement was a testament to the market's confidence in Enron's business model and its future prospects. One of the keys to Enron's early success was its ability to capitalize on the deregulation of the energy industry. Deregulation opened up new opportunities for competition and innovation, and Enron was quick to seize these opportunities. The company lobbied heavily for deregulation, arguing that it would lead to greater competition and lower prices for consumers. Enron's executives were persuasive, and their efforts paid off as deregulation policies were implemented across various states. While deregulation did lead to some benefits, it also created opportunities for companies like Enron to engage in risky and ultimately disastrous financial practices. The lack of stringent oversight allowed Enron to take on more risk than it could handle. Enron's expansion into new markets was fueled by a series of acquisitions and joint ventures. These strategic moves were designed to diversify the company's portfolio and reduce its reliance on traditional energy markets. The company moved into areas such as broadband, international energy, and even weather derivatives. These ventures were seen as innovative and forward-thinking, positioning Enron as a leader in multiple industries. While some of these ventures were initially successful, they ultimately proved to be too ambitious and difficult to manage. The complexity of these new markets added layers of risk that Enron was ill-prepared to handle. Enron's corporate culture, which emphasized risk-taking and rewarded employees handsomely for delivering short-term profits, contributed to this reckless expansion. The pressure to meet ever-increasing financial targets led to a culture of cutting corners and taking shortcuts. As Enron's business grew more complex, so too did its accounting practices. The company's financial statements became increasingly convoluted, making it difficult for outsiders to understand the true state of its finances. The company's management, under the direction of CFO Andrew Fastow, began to employ increasingly aggressive accounting techniques to maintain the illusion of profitability. These techniques included the use of off-balance sheet entities and complex financial instruments. These techniques, while not necessarily illegal at the time, were designed to push the boundaries of accounting rules and obscure the true financial health of the company. The goal was to keep the stock price high and maintain investor confidence. Enron's auditors, Arthur Andersen, turned a blind eye to these practices, lulled into complacency by the company's success and the lucrative fees it was earning. The lack of proper oversight and accountability allowed Enron's deceptive practices to continue unchecked. At the heart of Enron's downfall was a culture of deceit, a culture that permeated every level of the organization, and a blatant disregard for ethical accounting practices, which became the norm rather than the exception. The company's management, driven by insatiable greed and a relentless desire to maintain its stellar image on Wall Street, went to extraordinary lengths to conceal its true financial condition from investors, regulators, and even its own employees. Through a complex web of off-balance sheet entities and accounting gimmicks, Enron's executives created the illusion of profitability, while in reality, the company was drowning in debt and teetering on the brink of collapse. One of the key tools Enron employed to mask its true financial performance was the use of special purpose entities, or SPEs. These SPEs, often created with the help of complicit banks and investment firms, allowed Enron to keep billions of dollars of debt off its balance sheet, making the company appear far more financially stable than it actually was. By structuring transactions through these entities, Enron could effectively borrow money without having to report it as debt, thus inflating its earnings and deceiving investors, analysts, and the market at large. Another accounting trick employed by Enron was mark-to-market accounting, a method that allowed the company to recognize revenue from long-term contracts immediately. This technique, while legal in some circumstances, allowed Enron to book projected future profits from long-term contracts as current income, creating a misleading picture of the company's financial health. This practice, however, relied heavily on assumptions about future market conditions, and when those assumptions proved to be overly optimistic, it led to massive overstatements of Enron's earnings, further deepening the illusion of profitability. Enron's management went to great lengths to perpetuate the illusion of profitability, engaging in increasingly desperate measures to keep the facade intact. They pressured their auditors, Arthur Andersen, to overlook questionable accounting practices, effectively compromising the integrity of the auditing process. And they intimidated analysts who dared to question the company's financial statements, creating an environment where dissent was not tolerated. Enron's executives also benefited personally from the company's inflated stock price, cashing out millions of dollars in stock options while assuring the public that the company was in sound financial health, a claim that was far from the truth. Mark-to-market accounting, while a legitimate accounting method in certain situations, became a dangerous game in the hands of Enron. This method allows companies to record the current market value of an asset, even if that asset has not yet been sold. While this can provide a more accurate picture of a company's financial position in some cases, it can also be easily manipulated, especially when dealing with complex and illiquid assets. Enron, with its vast energy trading operations, argued that mark-to-market accounting was essential to reflect the true value of its long-term energy contracts. However, the company exploited the subjectivity inherent in this method to inflate its earnings. Enron's executives would often estimate the future value of these contracts based on overly optimistic assumptions, booking huge profits that were often based on little more than wishful thinking. The problem with Enron's use of mark-to-market accounting was that it created a disconnect between the company's reported earnings and its actual cash flow. While Enron was reporting record profits, its actual cash flow from operations was often negative. This discrepancy was masked by Enron's complex web of off-balance sheet entities and its aggressive accounting practices. As long as energy prices continued to rise, Enron's use of mark-to-market accounting went largely unquestioned. However, when energy prices began to decline in the early 2000s, the flaws in Enron's accounting became glaringly apparent. The company's earnings plummeted and investors began to question the sustainability of its business model. The house of cards that Enron had so carefully constructed was about to come crashing down.